What do we even need the government for? It's all shut down and things is melting up. We've been banging the drum for the last 2 weeks now, but how everything's lining up. The ingredients are in place for a massive rally before a blow off top to the bull market. We're going to have Fed funds at 2.5%. We're going to have a fiscal deficit at 6 to 6.5%. And then you have this AI CapEx build out again on top of it. I don't know. I don't really want to be calling any sort of cycle top at this juncture until I see something obvious. Forward guidance, Paul Tudor Jones on the same trade, so we'll see where that takes us. This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. The Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you there. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance, Roundup Edition. You got Quinn, you got Tyler, you got Felix. What's going on, guys? How's the melt up treating you?
Not bad.
Good, Matt. I'm super excited to see you next week, Felix, in London. Tyler, we'll miss you, man.
Tyler's got a real job. He's a real dad. He's got real shit on.
I don't get the invites. Ippolito forgot about when he got too big time. He's like, oh,
yeah, he's sold out.
Worth a couple $100 million now.
Excellent.
Just busted balls. Hey, Felix, by the way, I was thinking, do you know a guy named John Cusack?
Yes. Yeah.
Do you ever get that look-alike?
Yes.
You do? You definitely have
that. I've had that before, that I look like him.
We need a side-by-side because I finally hit me. Yeah. I was like, Felix looks like Cusack. But
we gotta
tie
that in there.
Dude, this is how I'm dating myself. He's like a 90s heartthrob, 80s, 90s heartthrob. You guys are so young.
High Fidelity, he was famous for that.
Yeah. And a lot of like crappier, random movies.
I never watch movies ever, but I watched Limitless this past week.
Yeah, I've seen that.
Kind of dark.
It's weird. Yeah.
Yeah. It's bad. I'm a good vibes type of guy.
Yeah, I'm a good vibes. I'm an action film guy.
My favorite,
a good action film in years.
My favorite movie growing up was Good Burger.
That's weird. That's very weird,
dude. It's because we grew up with like Keenan and Kel, all that unreal content.
Speaking of good vibes, you know what's a good vibe? When the government shuts down and you just never get data again. This was like the quietest week of economic data I think ever, because it was already a quietish week, and then like you have no claims data, you have no nothing, and we just grind hard. A little bit of a sell-off yesterday, but overall, like, man, what do we even need the government for? It's all shut down and things just melting up.
I was saying, because today I saw the headline come across that they're cutting like 50% of the IRS or something, 50,000 IRS or something.
Yeah,
I was like,
laying them off.
Like, this is so strategic. Democrats think they're getting a victory. Meanwhile, Trump's just gutting the agency before he hauls like 10 billion on crypto in Q4. And he's just like, IRS is gone.
Yeah. I wonder how long do you think it takes? I thought it said like Kalshi said something like another 2 weeks or so until the shutdown ends.
Yeah. I have a slide in here actually of the odds. Felix 38.
Let's pull those up. Pull those up, Jamie. Pull those up, Felix. Yeah, here we go.
Yeah,
we should start saying that. Pull that up, Felix.
Yeah. It's about 30 days, like 10 to 29 days, like probably on the further end, sometime later this month.
We're in it now. I think the record one was like 30 days in 2018. So feels like we're probably going to get a record there. It looked like they tried to pass something today. They tried to pass a spending bill and it got shot down. So yeah, I think we're in it. We're never getting bearish data again. So that's
it's kind of strategic too. I think, to be honest, like it's not bothering the market, so they have no reason to rush, and it's probably bringing bond yields down a bit. So it's like helping liquidity. It's making the Fed more cautious probably on the margin. So they get kind of guaranteed the cut. It kind of makes a ton of sense. Democrats have like no cards to play. I don't know. It's classic government grandstanding.
Yeah.
What's incredible to me is if you go, this is one of my charts, but it's the second to last chart, 52. This is realized volatility. This is from the Piper guys, the best vol guys in the biz. This is the blue line is 30-day realized vol inverted, and that's obviously super low. If you look at it, it's like 6.84 realized vol, which supports all of the vol control strategy. So as realized vol stays low, all the systematic, buying that happens, they keep levering up as realized vol is lower and lower. And so this is like the melt up scenario from a volatility perspective perfectly. What's interesting is like a couple of years ago during these government shutdowns, people would buy so much protection, be like, oh my God, the government's going to shut down. Things are going to be horrible. Not anticipating they're just going to come to a deal and everything's going to be fine eventually. But, this is, it's kind of wild to see, now people constantly discount all these events now. And I think they're probably concentrated on the right things. So we'll see.
Yeah, I feel like nothing ever happens is kind of the base case for a lot of people now.
If you really think about it, the nothing ever happens meme is a direct result of central bank intervention, because it doesn't fucking matter. Like that's the point of that meme. It's not that nothing ever happened. Yeah, it's like that is that meme. You like whoever can thank the central banks. Felix on side 34. Sorry, I was just going to go to it, but it actually I pulled it from the SIBO Monday morning vol report, and shows the same thing Tyler's saying. This week, 1 month implied realized spread widened to the 99th percentile high for SPX. The volatility premium is not just elevated for SPX, but across all global indices, Qs, etc. So basically, the hedging demand at the index level is super stretched relative to realized. A lot of this is earnings season coming up. There's a lot of people who are sort of hedging index volatility and playing single name stocks. So you're seeing more dispersion right now, but it creates some very interesting flow dynamics, to Tyler's point on if you continue to get this. Jem Carson always says actually the time to short volatility is when volatility is low because of this effect right here. It's harder to get that.
Well, you're just generating yield when implied vol is higher than realized. It's a larger spread, and it's just all the yield generation farming in the market just keeps happening. So we'll see it once earnings come, and we did get a little bit of credit spread widening today, which was kind of interesting. I was wondering if that was, we'll probably know in hindsight whether it's a large supply of high yield or some sort of debt's coming in the market, or if it was government shutdown related, but something to pay attention to if we get a volatility spike in the equity market and the deleveraging here in the next couple of days, because we are in buyback blackout season for the next 2 or 3 weeks. But then after that, we're seasonally, it's very salubrious.
Yeah. Also, like earnings expectations are pretty muted. I mean, I feel like there's a lot of interesting things that could happen to this earnings season, because there's a lot of concern about what are corporate profit margins going to look like with tariffs starting to really set into place now. And shout out to Lord Fed on Twitter. He writes a really good Substack. But he wrote something about just where EPS growth is at. So I'll just read this out here. But consensus is calling for roughly 6% year over year EPS growth in Q3. Not exactly inspiring, but here's what matters. This entire meltup has kind of followed the same script. Analysts underestimate, companies surprised, and the market rallies on disbelief. Rinse, repeat. And believe it or not, the bar for Mag 7 names is sitting especially low right now, earnings growth expectations have been cut nearly in half versus last quarter's actual results. Whether that's sandbagging or real caution, it doesn't really matter. What matters is the setup. So yeah, shout out to him. He writes some great stuff. But yeah, really interesting to go into earnings season if that is the mindset of where analysts are putting things right now.
You know what's interesting is that from an index basis, it's kind of, that feels like expectations are low. We'll probably beat them. But if you go sector specific into like some of these crazy ass pockets of the market where these companies aren't making any money and call volumes are insane, I feel like watch yourself. If you're in, the quantum computing sector where they're not making money really, but they have outrageous market caps on earnings, that's a catalyst to really get flattened on those call options and call option. I'm just trying to, risk adjust a little bit after the move.
Yeah.
Some of these things had.
I mean, that's what's so hard about this. I mean, yeah, we came up pretty guns blazing bullish last week, and then we tried to, gut check ourselves with some positioning charts. But then I don't know if you guys saw, but the next couple days afterwards, Tudor Jones was singing the same tune. So he's saying that the ingredients are in place for a massive rally before a blow off top to the bull market.
Shout out to Tudor Jones for being a forward guidance watcher.
Yeah, he listened to the Roundup. And
he puts it on his TV on Saturday mornings, I think.
Yeah. Then he goes and repeats it on CNBC.
Man, I would love to have him on the show one day.
Oh my God, he's such a beauty. I love his accent.
Oh, he's so good. He's so good. Yeah, he says the difference between now and 1999 is the U.S. fiscal and monetary policy, Jones noted. He believes the bull market still has room to run before it reaches its final phase. So this is the difficult situation. Is the last move is the most violent, the most parabolic, and that's where, yeah, like it. I think we're all three of us are confident where we're about to go, but it's also it's a stressful time to trade. You can still get, if you get a violent upswing, you can get a violent pullback and then reset higher. And we kind of got that yesterday in crypto markets where there was a pretty good liquidation flush. So you kind of still got to keep your wits about you. How do you guys navigate that? Because you know where we're going. It's just like how to get there in one piece.
Sell the rips and you buy the dips, baby.
20x leverage and get liquidated on each little dip and then go home.
Liquidation is my stop loss.
Yeah. You have to pick your view, and it's crypto. I mean, I think we're playing for plus 30% on corn and more on others. So like you have to set your stop losses appropriately. Like if that's your view, then 10% downside, whatever, maybe more, like is that's still a 3-to-1 risk reward. So you have to respect the asset you're trading, I think.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
To go back to that Tudor Jones interview on CNBC, he said something. This was, I thought, a great on humility for everyone who manages money. He said something. He said, 6 months ago, he was expecting a recession. And then Andrew Ross Sorkin called him out on it. He goes, 6 months ago, you were expecting a recession. And Tudor Jones goes, yeah, that was a pretty bad call, wasn't it? and he kind of laughed it off. And like, this is where, when you're sitting in the seat, you can change your mind. And I think, this is where I wanted to lead to Quinn. A lot of people don't get is like, if the facts change, you can change your mind. And that's what the best in the business do. Tudor Jones has the ability to flip on a hair. Stan Druckenmiller flips on a hair when the data
George Soros, legendary at it. Like just, yeah, 100%.
Oh, I did want to, ask, Quinn, what made you switch from, ETH on ETH? Like what was the steps that like in your mind when you went from, you got a lot of heat when you're like saying it was dead, but then now you're now a bull. So I want to hit you on that one.
It's actually funny because it's one of the things you learn about being public too. When you have a view, either out of compartmentalizing, the human mind likes to like compartmentalize people into a view. He's a bull, he's a bear, binary. And there's almost this like stigma where it's like people, like it's just like a human nature. I'm better than you. Like you were wrong. Haha, I'm right. Like punishment of like you were wrong. You can't change your mind. And it's like, well, like you can sulk and just hold out. It's a hard thing because you're wrong. So one, you have to come to grips with that, and you probably lost money. And two, you you have to update your views. You still could be wrong when you update them, but like it's a way worse look to just ignore information. And I mean, the ETH is like a little more tactical here, with some dynamics, which we can go into. But broadly speaking, yeah, I actually had my quarterly investor update call today and ran through this whole economic reacceleration case for next year. And I laid it out last week a lot, where oddly, so since the start of the year, 10 years down 50 bips, mortgage rates are at 3-year lows, oil's down 15%, and government deficits are still high, but personnel's down and there are spending cuts being made. Entitlements, Medicare, SNAP. So like, I got to give it to Bessent, man. Like he's kind of doing it. Granted, caveat, how that's all occurred with no market hiccups outside of Liberation Day is messing with the money supply and debasing fiat currency. That smooths all cracks over. So I don't love that that helps the rich and makes inequality worse and basically kicks the can on what political issues come from this. But those are the facts. And so nominally, the road's smooth. And the market's 3 to 8 months forward looking. 20% decline in April was pricing in the recession. We're sitting in October. 3 to 8 months from now, what's going to happen? This is why I'm a dollar bull. I think the US economy is going to reaccelerate. I think Europe's in stagflation again. I think, yields aren't really a problem now because I mentioned oil. But eventually, when the economy reaccelerates, I think next year long-term debt yields probably rise 100 bips. So I'm just more of an economic bull because we've traversed this most treacherous period, and next year tariff effects roll off, the base effects from year-over-year immigration reduction rolls off, and you have to be forward-looking. So you want to hold your view, set some invalidations where it's like, okay, I was wrong. Was I early or am I wrong? Okay, what are some things I can put lines in the sand I can draw that say, from a time and market price perspective, you have to play both, where it's like, okay, listen to the market from a price action perspective, but also a time. If we're 6, 7, 8 months post tariff announcement and there's no damage like to the market, not saying there's no repercussions, but you can't sit there and be like, oh, they're gonna come someday, like in Tyler's voice. So I think it's just like, you have to, yeah, like you said, just be super flexible and lick your wounds. And there's a new opportunity every day. I mean, you don't need to be in every trade, and it's 2 steps forward, 1 step back. It's like when you're working out and you can take a rest day and heal your body and have energy for your next few workouts, or you can get hurt and your body's going to say, hey man, you need this rest day, and then it takes longer. And it's kind of like that with investing, where it's like, in everything in life, you're like, you can kind of pump the brakes so you got them preemptively, or you burn out and hit a wall, and you have to it takes a little time to dig out of it. But that's how I think of it.
I think it's just so important to just have nuance in your discussions. Like, it's just, I don't know, it feels like Twitter the past couple of weeks has just been batshit crazy. Like, people are just very emotional, very political, and are kind of losing their minds a little bit. And I don't really know what it is, but it's kind of nuts. Like, for example,
isn't it awesome? It's happening right as the market volatility has come to a complete pause.
yeah,
It's
just like
the market barely moves. It barely moves.
We're grinding up, and people are losing their minds.
Yeah.
And like, look, okay, so Stephen Moran, he's been on the show, he's had some things that are inaccurate or hyperbolized, and he's had some things that are valid. I've seen people, he came out with an interview this week where he mentioned, I think the national interest rate, R star, is at 0.5% now. And the reason for that is a huge shift in population growth. We went from the highest amount of immigration to the lowest amount of immigration. And then people were like, tagging him in the screenshot from a bullet point that he made a year ago when we were in a completely different situation where he said, I think R star is higher. And then since then, we've had the biggest shift in immigration and population growth that we've ever seen in an economy. So of course you would want to change your views, but people are still holding him against this view that he had before that change. And I think it's just another example of what that looks like, to be able to flip on a dime. And I don't know. It's just we're losing all nuance. I think it kind of drives me crazy.
I think that's what happens when you're moving from a fourth turning to a first turning. Is like,
yeah,
there's no real leader to create a reality, and I think it's like battling of realities right now. And I think we'll take some time to actually figure it out. But what I will say is, I think people are starting to realize that on fiat currency, there's that 8% hurdle rate. And they're realizing, oh my God, I've been keeping my money in a money market fund and it's getting chopped up by monetary dilution now. And there's some psychological shift has happened there, along with Japan. I think Japan is the most important thing right now on the planet that I don't really understand that well, but I know enough. And I'd love to run through some Japanese charts from Russell Clark, who's one of a great macro thinker. To give him a shout out, I think we should get him on forward guidance at some point. I think bears are smarter than bulls in general when it comes to big macro thoughts. And this is from his Substack, but I'm just going to read a couple things. So shout out to Russell. He writes, this is slide 47. He's talking about essentially the world we live in, which is he has this capital to labor type cycle. And he says, in the pro-capital, pro-free trade era from 1980 to 2000, we learned that the yen was a hard currency. For all the fiat debasement traders out there, Japan was a true widowmaker market. With rising debt levels and a fiscal deficit and central banking putting interest rates to zero, you would have assumed gold in yen terms would have soared at least during the 1990s, but you would have been wrong. The gold price in yen terms fell back to 1971 by 2000. So this is a chart of gold in yen terms over the last 40 years. And you can see the yen stayed strong, which is counterintuitive to what we'd think about, with large fiscal deficits, rates at zero. It actually was the widowmaker trade, and people tried to short, Japanese yields, and it just didn't work. And then if you go to the next chart, this is slide 48. He says, and this was not your average retailer that got yen and JGBs wrong. It was Nobel laureates, head traders, and big banks and hedge funds. What did they get wrong? For me, it was always the yen. While the BOJ was always desperate to get the yen weak, the government, under pressure from the US, was never too keen to intervene in foreign exchange markets. The Japanese government was committed to free markets, or at least convincing the US government it was committed to free markets. With no inflation in Japan, this meant the yen would always need to appreciate. So essentially, that period was really that's when economics worked, and your economic experts actually, things worked from an economics perspective because it was a free market. That's the difference. I think when I say markets are political utility now, it encapsulates this. Is we're actually way more centralized and politically driven than we are free markets driven. And that therein lies the why Gen Xers and Gen X experts have largely been wrong in this backdrop, is because they don't realize their markets are a political decision. So if you go to slide 49, he goes, despite this, macro managers are repeatedly making the mistake they made with JBGBs. They're expecting the yen to appreciate because rates are going higher now, right? In Japan. So they think, oh, the yen's going to appreciate. So, and at that point, you see everyone jump in and they go long the yen, and now it's short and get squeezed out. And so the last thing he says here, the next chart, is he says, As I've been writing for a while, macro investors could rely on economics to justify positions from 1980 to 2010, but because political census was to allow markets to price everything. In a political world, long yen is a widowmaker trade, and old school macro traders look foolish. The big question is, when do the politics change again and the dogmatic debasement traders look bad again? It's happened before, so I'm pretty sure it'll happen again. Could be tomorrow, could be after I die, but all I know is to keep an eye on politics. So basically, this is gold priced in yen now. So like we're seeing now the yen theoretically could, because it's a political decision, could devalue, right? Like we could be watching the yen actually devalue as rates go up. So it's kind of counterintuitive. You'd think like, oh, rates are going to go up, money's going to flow back into Japanese bonds and the yen will strengthen. But it's kind of counterintuitive here, which means if the yen weakens, the dollar will strengthen too. And therein lies the carry trade of all the foreigner money coming into the US equity market, that 1998 type boom, right? And so that's I think that's the counterintuitive part to this whole thing is it relies on Japan. And when you see big FX moves from Japanese yen, that will change the dynamic of the market we're in. And there'll be fits and starts, but I think this debasement trade is here to stay. Does that all make sense? Like, and shout out to Russell. Like, I mean, this is a brilliant macro thought. He's very bearish, I think, in general, but I read this and I'm like, holy shit, it's kind of bullish.
On my LP update call today, I think I said the word debasement so many times. People are probably like, Jesus, like, shut up. We know it. Like the theme, it's becoming mainstream news, but debasement trades will take different colors, flavors, and shapes. And right now it's gold. Felix, if you want to pull
gold
up.
is canary in the coal mine. I think that's creating this common realization, because outside of that, when you have like the Dixie is just comparing a fiat against a fiat, so you don't see that debasement happening. But when you look at gold, you're like, oh shit.
Yeah. And on 42, Tyler, to your point, just to explain to people, so JGB yields are flying because they have an inflation problem and their economic growth is reaccelerating. So long-term bond yields are soaring, and also no one trades in that bond market except for the central bank, and no one wants to own it. But the thing is so yields rising because of inflation, and the currency's falling, weakening because the central bank is not doing anything to stop inflation. They still have interest rates at 0.5%. So the currency, they're sacrificing the currency. And I don't know if you look at the yields chart this week, it's very likely they intervened into the bond market this week to stop the rise, because there was the election of another global spender, the new president over there, new prime minister over there, and the bond market and equities just flew, or yields and equities flew, and they likely intervened, and that's why you're seeing the yen move like that. But like you said, it's strengthening the dollar, but it's strengthening the dollar for good reasons, more liquidity. And that's sort of I'm really bullish the dollar, because I think the US kind of excellence trade is going to come back in a way, because Europe, they're already at zero real. The economy's in stagflation. You have this problem in Japan, and liquidity is fine over here. So the dollar, everyone's pointing to this dollar strength as a reserve shortage and all these things, which are there and need to be watched and need to be monitored when it comes to credit spreads, et cetera. But I think people are latching on too hard to that. And so anyways, side note on back to gold, this chart of gold call volume minus put volume, like we're getting so close. And then to the local top, I don't think gold's run is done at all. But and then I check Twitter, you see Chamath and Jim Cramer both tweeting about it. And then if you go to the next 143, it's tough to see, but this is euro dollar, and I think this thing's coming right back down. Like, people positioning is max short dollars, and you have this economic divergence, yield differentials favor dollar here. So it's and the funny thing is how this all relates and makes sense is during periods of dollar strength, and as Felix mentioned, this is fiat to fiat strength. So, this doesn't mean liquidity or no liquidity, but dollar strength, Bitcoin outperforms more often in dollar strength than gold does. And so the reason for that is because that means economy good. And where does most of the flows into crypto come? From the US. And so it's funny how dollar strengthening sort of cracks gold at the top of the gold peak, and then the capital rotates into a higher beta, more geared towards economic acceleration, debasement trade, Bitcoin, and other industrial commodities. I don't know about oil because you have all of that, supply stuff going on, but copper, palladium, platinum, silver, all of those are highly likely to outperform gold in the next few months because the baton gets passed to higher torque.
I love that.
Throw one more chart
Yeah.
into this is just looking at how much runway we have. It's just this chart of real yields against gold, because this used to be the correlation for gold, and it broke basically around the Ukraine-Russia war invasion moment. And ever since we've seen that, and you can see this has all happened without the increase of negative real rates. We've been chopping around. We haven't seen that happen yet. Yeah, I think for sure. I mean, when you got Chamath talking about bull posting gold, you got to be a little hesitant. But man, we still haven't even seen the real rates run yet.
Check this out. This is crazy. This is the last chart, 54. In terms of, this is from TD's, report. This is what's wild to me is we've seen a generation. How many millennials or Gen Z do you know who own, gold stocks? Negligible. I mean, how many barely boomers probably don't even own gold stocks? Yet the free cash flow with prices where they are is just ripping for gold stocks. So I think what's happening is the market is, if you just zoom out 40, 50 years, we piled money into, technology and all this other stuff. And we created products like ETFs and passive to just funnel money into, these large pockets through 401ks, through pensions, through endowments. And we completely forgot about the precious metals market. And now that the con game is up and everyone realizes, oh my God, this is just the giant fiat, debt bubble. Like that's the real bubble, is the debt bubble, the global fiscal debt bubble. That's where it all is. And now all that money has to go back into these tiny market cap companies. And think about the amount of capital from like pensions, endowments, and that has neglected this space for years. I mean, it's kind of wild. They haven't dug up gold for 10 years because it was unprofitable. And now it's coming back. And and the fundamentals are great. Like, it's going to be hard to derail this secularly. It might be overcooked in the short term, given the short-term vol characteristics. But if the con game is up on fiat and this you just have to deleverage your economies across the globe. Japan just, voted in the, it's clear Trump and everybody in the policy in the US is deleveraging the economy through fiat dilution, debasement. This is the new world we're living in, and giant aircraft carriers of capital are going to have a tough time moving it fast. So I think it's a giant short squeeze on power assets, on precious metals, on crypto, basically anything that has been neglected or has a short supply and has to flow back in there with these mandates. And I think that's we're just seeing the beginning of it.
You're so right. You want to hear a funny thing? Shout out to our boy Will Clemente, who tweeted about this morning. But so gold is a percentage of the stock market's market cap, the U.S. equity market cap. We're talking 25 trillion for gold, let's say, or whatever. And U.S. equity market cap is 100 or something like that. It's like, or it's probably, I'm off on this one. So excuse me on this one. But the one that's awesome is, the point is gold is very much smaller than U.S. equity market cap. And every 1% in gold on 25 trillion is 250 billion. And it's up 20% in 2 months. So it basically added, in the last 2 months, gold added 2 Bitcoins worth of market cap.
Yeah.
So there's a clear relation between the two assets. And I mean, if there's rotation, as Will pointed out in his tweet, it sets a nice stage.
Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHX Felix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
You know what else is kind of crazy? I put this on Twitter. This is slide 52. So a slide guy today, but I love these. These are my favorites. The incredible shrinking stock market. Like back in, just to give this a relative, you could make the argument like everything's more so efficient now that there's less supply of stuff. Meaning like you had a lot of crap companies, try not to swear as much, on in 1995, there's 8,000 companies that were listed on stock exchanges. And now we only have, 4,642. And, a lot of those are meme, nonsense, but relative to where we were back then, it's kind of nuts compared to the level of fiat currency that has been created since then. And to me, I just step back and I'm like, how many productive assets are there that stay ahead? The growth stays ahead of the monetary dilution. And therein lies the big view of things. And everyone keeps surprising. The market keeps grinding higher and higher and higher. And I think this is largely the reason. There's no supply of productive assets.
Agreed. I think that's a good actually segment of what I wanted to talk about here, which is just the recursiveness in the AI CapEx investment going on right now. Mm-hmm. And so that's kind of part of the question. There's been a lot of Cuppy wrote another good follow-up piece this week. I don't know if you guys read it, but just looking at this nature of the recursivity between, it's like NVIDIA invests in the OpenAI, rents NVIDIA chips. And it's just like this constant recursive loop. So we got this one from AMD this week that skyrocketed 30% as OpenAI looks to take a stake in the AI chip maker. Then he had this other piece on the right that came out from Bloomberg today, just trying to map out all this recursiveness. How do you guys think about this? Because to your point, we have this compression of the amount of companies available. And then every single week, more and more of the market cap of the main indexes is just having to do with AI. So this is just looking at how much of the S&P 500 is related to AI stocks. And it's just kind of grinding higher. Like this chart is going higher as the amount of companies publicly available is going lower. Like, how do you guys think about that?
Go hit me with slide 51. I think about it like this, which is, I think this is just all these cycles are debt cycles, right? And AI is now the largest segment of corporate debt. They make up 14% of the high grade, investment grade corporate debt now, and it's ballooned to 1.2 trillion. I don't think this thing is over completely until we see like a super binge on debt. Like it was kind of like when you see back in 2008 and everyone was rushing to buy a house and all the debt was flying around getting traded for subprime. And I think that's when you see this thing spike to like 2 trillion, I think that's when we got to start being concerned. And there's cracks in the market and like, office CRE and, business development companies and weird, loan stuff. But on the whole, this is where the big boogeyman is. And I just don't, with the cash flow that all the FANGs have, I just don't see it breaking in the short term until you get the volatility spike on bonds. Like that could derail stuff, but the government really needs this to work. They're building the 21st century railroad, infrastructure right now. And they need to lower the cost of capital to do that. And I think if, these stay cash flowing, like these giant companies that are issuing the debt, I think it'll be fine. I don't know. Maybe Cuppy has a different read on it, but
yeah, I mean, I think one of the criticisms I heard from that, and shout out to David Cervantes Pinebrook, but he brought this important distinction he mentioned in there, is that the difference is that a lot of this build out is being funded by cash flow from operations. So it's free cash flow they actually have. Like this isn't as yes, we're starting to see some debt financing now. We're seeing very little equity financing. So there, it can't really be levered if it's just free cash flow. Maybe you can make the argument it's unproductive uses of that free cash flow. That's a different story. But the fact of the matter is, instead of just throwing money as dividends to shareholders, it's like, all right, well, we're going to invest it instead. So there's not really like I don't know, systemic risk. Maybe if we do another few rounds of this debt financing between the same four companies, you can make a different argument. But as it stands now, to me, it's like it's kind of noise. I think
you'll start seeing it in the credit spreads when the debt investors don't want to back these companies and they start getting worse and worse fundamentally. And if the cash flows can't keep up and satiate the debt, then we'll be watching that. That's what you have to watch. But I don't know. They're all the businesses. Zuck says it's existential not to invest in this stuff. So it can get way weirder. I just think what's the weirdest outcome, which is like complete melt up and everyone's making money hand over fist. We're starting to get to there. I don't know. If you had to push me on it, I'd say like sixth or seventh inning. A lot has to do with policy too. But it could be the third inning if this is a government mandated policy to grow your way out of the 130% debt to GDP. Like this could be years. They did this for years during the 40s. They delevered the economy after the war in the 50s. So I don't know. I'm erring on the side of like it'll get a lot weirder before it gets. It's hard to fade these things. Is what I'm trying to say.
Quinn, what's your read on the AI build out?
I'm kind of in the cuppy camp, but like investing is the classic paradox, like of always holding two things in both hands and trying to be balanced and find when the best time to express it is. And you need a catalyst. And I don't think that catalyst is coming in the next few months. I think the risk reward for buying a large cap equity index here is very poor. 40% of it is these Meg 7 CapEx spenders. So yeah, I don't love that because I'm in the full debasement camp where not necessarily gold, doesn't have to be Bitcoin. Pick your commodity, pick your thing you can't print of choice and invest behind that because I don't like the risk reward of multiples here on the indices, but that also doesn't mean valuations work over years, not months.
Yeah, I mean the big question at hand is like, how do they monetize this? I was listening to Citrini. He was on Odd Lots this week, and he's been on the show before as well. Great guy, obviously very savvy on AI build out, and they were talking a bit about what's up with this. Like, are we trying to build the machine god AI singularity, or are we trying to build out AI slop video like Sora that OpenAI came out with, and trying to balance the two because obviously all that we've got so far is AI slop and we don't have machine god yet. But it seems like the play is this: they're trying to at least get some interim revenue while they try to pursue machine god AGI. But in the meantime, it's like, okay, well, all we have is Tyler standing on top of a horse with a cowboy hat riding around in space in the moon, like that's what we have for AI. Yeah. So I don't know where that nets us out, but
I think there's productive things. I use it every day. Like
true. Yeah.
You have a handheld, MIT kit in your pocket where you're like, oh, what is this? You can ask anything about any stock. And it's really incredible. It's going to decimate, your first year banker. I think not the high end bankers, but like the first year banker.
Let's end this journey here talking about crypto. Quinn, as you already mentioned, you are now an ETH bull after being an ETH hater for a long time. And there's another ETH hater that took your spot. Carousel Capital came out today and decided that they put out a short report against Tom Lee's ETH Treasury DAT. Choose your fighter. Tom Lee, Supreme Bull, or a short fund who's I can't make fun of short funds too much now because Tyler Bush one of them.
I think short guys are usually right. It's just the timeline that, I will say, like, they're really great with ideas and they're usually very well researched. They're way better researched than the long guys. But I think the problem is the market structure forces are so powerful. So you have to understand that. And specifically, this is like a hero short.
That is the hero short. That's like, yeah, like, okay, walk us through your thesis though, Quinn.
I haven't read the report. I need to. So this is an indirect response then. But if you go to the next slide, so why ETH is interesting. So BM&R, this is really small. You can't really see, but the chart on the bottom is MSTR's implied vol, and it's been hovering around 50. Oh, sweet, thanks. Yeah, it's been hovering around 50, and BM&R's implied vol is still up above 100 in the 100 to 120 range. So, moral of the story there is there's still a lot of volatility to harvest for BM&R, selling that via converts, selling that via other, the ATM, etc. This is also without them launching 2x ETFs and all of the different kind of additional speculative vehicles on top. So if Tom Lee, if you're listening, like when is the 2x BM&R and the covered call BM&R ETFs coming? Because those will help you. On the next slide, Felix, you talked about this last week, but ETH treasury companies have accumulated more percent of the ETH network in 2 quarters than Bitcoin treasury companies did in basically 5 years. And I think the important thing to recognize here is BM&R's trading volume is, like 60% of MSTR's. And yeah, it's a smaller NAV, but that's really important for how many shares you can issue and how much you can buy. But even more importantly is the size of ETH market cap is like 20 to 25% of Bitcoin. So the footprint that BM&R can have in an up market, everybody, learned their lesson in 2024 and kind of earlier this year that like you shouldn't fade Bitcoin dominance when MSTR is just pummeling the purchases. And it's kind of the same thing here. Like they're absorbing so much supply, and it's still a pretty strong case. If you go to the next one, is digging into the spent volume and profit by age. And it's basically the biggest profit taking in ETH over the last couple of months, because it's like the first pump in years for the poor asset. So you've had the biggest profit taking since like 2020, 2021 timeframe. And if you go to the next slide, liveliness, basically this is a measure of how active old coins are. You can see that vertical line from late 24 to now. It's the most lively period for coins since early 21, meaning what I just said, the most basically long-term holders taking profits into this pump because it's the first pump they've seen in years after ETH's been hated on. But then when you zoom out and look at a positive macro picture, next slide shows, shout out to Crypto Insights Group. They do this awesome investor survey, the one before this, every month, which shows, ETH has really come down in terms of like crowded trades, hype, SOL, all above it. Everyone's excited about the SOL DATs. And so positioning sentiment is reset. The next one shows open interest, coin open interest is down about 20% from the highs. So old chart, so it might be a bit higher. And then the next one is if you actually plot the Russell small caps versus ETH, it's quite similar, and they both topped in 21 and 24, reversed, and Russell just broke out, and presumably ETH is probably going to follow. It makes sense. Bitcoin is like the S&P, Russell's like ETH. The other one that's actually interesting, ETH BTC is silver gold. That I didn't include that, but you can look that up. And then the last one, which a question I just asked Kerrisdale, is this is the chart of BM&R divided by MSTR. So why short this one? Like this thing hasn't even sniffed like its 50-day moving average. It's just bouncing off the 20. Like there's short MSTR if you want a short one.
You're also going against, was it Stan Druckenmiller and Peter Thiel? It's like I think they still both own it.
As far as I know, which is crazy. That's like,
I mean, anything Thiel does long term, I'm just like, there's like 10 different layers that you're probably not understanding that he does, where it's like they're going to be using ETH as like a decentralized banking system in 5 years, and like his track record is so disgusting that has ballsy going against that guy, and Druck too, obviously. But Druck changes.
I think there's just I mean, I've had to catch myself many times, but there's so much PTSD and trauma in the as crypto investors on things that really you have to rewire, because it's a whole different asset class with ETFs and being put on the global macro main stage. And so, yeah, traditional analogs, things like the 4-year cycle, I don't think are gonna hold up anymore. And so there's opportunity there, and I think this is one of them. Obviously, ETH ran a lot this year, but for some reason, it's still people's first go-to short asset, and these are like pretty bullish dynamics in its favor.
Yeah, I think the 4-year cycle's done. I mean, the halving cycle has way less of an impact now, and then the macro cycle, like the reason the 2021 bubble popped or ended, the cycle ended, maybe let's not call it a bubble, is because the Fed did a pretty aggressive pivot and did the fastest hiking regime in 30 years or whatever. So that's what caused that one. Back in late 2018, that cycle got ended by the Fed was trying to do QT and raise rates, and we had that blow up in the market in Q4 2018, and then they pivoted afterwards. But that whacked risk assets. So I don't know. I just think it's still mostly driven by macro and risk on sentiment and environment. And when I look at that, the macro is pretty damn good. I mean, we've been banging the drum for the last 2 weeks now, but how everything's lining up. Like you have Fed funds coming in. Like this is what Paul Tudor Jones said, is that, all right, you have Fed funds in the next year or so with a new Fed share coming in. We're gonna have Fed funds at 2.5%. We're gonna have a fiscal deficit at 6 to 6.5%. And then if you have, depending on what we do with the tariff revenue, if that goes out of stimmy checks, or if the Supreme Court knocks it down and they have to refund it, that's pretty absurd. Suddenly you have a fiscal deficit between 6 and 7% again. And then you have this AI CapEx build out again on top of it, where you're just, constantly getting that churn higher. You have those three vectors. Like, I don't know. I don't really want to be calling any sort of cycle top at this juncture until I see something obvious.
What does give me cause for concern is these two charts, which is slide 45 and slide 46. This is slide, if you go there, this is from Morgan Stanley's quant team. This is if you go, so this is the first one, rolling 1 month estimated retail demand. You can see that it's obviously like very, very high, about 100 billion. And then if you go to the next one, it says retail investors have bought over 100 billion U.S. equities over last month, based on public data, the largest 1 month buy on record, just eclipsing post-Liberation Day binge. This incredible demand is squeezing shorts. Their short basket is up 18% since the start of September. It's kind of wild, but that, I don't know. You could make the argument that this has legs because a lot of this money was parked in money market funds, and we were in a cash bubble, but this will be really important to watch heading into the fourth quarter, because if retail goes away, we could see a big smush lower before, even if the economy's pretty good.
I think it's important to like give some respect to retail though. Like I think they're just secularly getting smarter, and like I don't know, I'm retail too, I guess. But in April during Liberation Day, they were buying the dip while hedge funds are selling. They caught the bottom first. I think it's disingenuous to completely discount them in terms of their intelligence.
Okay, this is a bigger thing, and I think I've mentioned this a couple weeks ago, but how much of this is the natural decentralization in the market, where, okay, you have all the floats of all the passive are getting choked up in this environment. In retail now, it's like GameStop, and I wrote about this years ago, so you can go back and fact check me, but I was like, this is the inevitable end game of a very centralized market, is you have retail that sniffs out float imbalances. And then you have like people like Shardy B who go out and they sniff out basically, where stocks are breaking out to the upside, and they're all honing in on the same supply and demand imbalances here, because all the floats are choked by certain passive investors, and then they go out and create gamma squeezes across the market. And I think this is the inevitable problem with passive. When you have a debt to GDP of 130%, you have boomers taking up all the floats through their 401ks and pensions and endowments and mandated public investing. This is the inevitable end game, is retail figures it out and then completely owns institutional asset management, and then it decentralizes, right? I think that's actually what's going on. But the big thing is policy can shift and then retail gets blown up. Policy. But I think policy, if we're analyzing the macro correctly, we could be seeing the beginning of this retail thing where it's like, oh my God, passive is going to massively underperform, and long short hedge funds are massively going to underperform absolute alpha funds. Where if your beta is neutral, you're going to get smoked in relative terms. And maybe that's the secular shift that we're seeing here, is this movement from, if it's a fourth turning, first turning, the end of the fourth turning was, risk averse, risk adjust my returns. And you're doing that at the same time the government has to force nominal growth, right? Which is the irony of the whole thing, is like, why don't you just go along with the government? Why are you shorting when the government's telling you to go long entire sectors through money printing?
Yeah.
So it's I think that framework actually is working really well for me, where it's like, but then where it works for Muddy Waters specifically is you have a lot of sociopaths that come out and fraudsters. When money is just free, you do have a lot of fake companies. So you have to be concerned about that.
Quinn, anything to add on that point of retail?
Yeah, I just to the point of like all these metrics you always see, right? Like, this is the highest options expiration by volume ever. This is the highest buying level ever. This is since 2021. Well, the S&P's up 45% since 2021. So, and your Coke Zero at the grocery store costs 50% more, and nominally everything is way higher. So I think it's important to look at understand that dynamic when you're looking at these metrics that are showing all-time highs.
Yeah, good points. All right, guys. So I think we can leave it at that. Cover a lot of bases despite the week of quiet data with this government shutdown. But yeah, risk on. Forward guidance and Paul Tudor Jones on the same trade. So we'll see where that takes us.
I like that as our rider.
Yeah, exactly. All right.
How many? Oh wait, last thing is, how many boomer Gen Xers do you think are gonna have mental meltdowns as the market grinds higher here when they risk adjust their returns away?
No comment.
There will be some
out of people to interview if that happens.
You should probably long Twitter meltdowns in addition to whatever else you're longing.
Yeah. To me, that got me more bullish. I'm like, let's go.
I love it.
No, it's good.
All right,
boys. It's good. All right.
We'll see you
guys at DAS. Have a good weekend.
Take care.